Okay, I think it's good to do one final video that ties together all three of these things: the cash flow statement, the income statement, the balance sheet, and give you an idea of why do we have to understand all three of these? Why can't it be simpler? Why do I need three freaking documents to understand what's happening with a business? These are confusing. So to illustrate why you need all three of these, I'll sort of draw them out and show you that they are unique if you just do sort of an overview summary. They are unique perspectives. They tell you different things. And you can be fooled to some extent if you only look at one of them. So the balance sheet, I like to think about this as a snapshot. The balance sheet gives you an idea of assets and liabilities. We talked about that. But it sort of just shows you for this window of time, here's the company snapshot. This is what it looks like. And that gives you an idea of where it is at a given period of time, but it doesn't exactly tell you where it's headed. To get more of a direction, I'm going to do this over here. The cash flow is more of the direction, a little bit more of the flow is a good term because it should make you think of movement. And you get an idea of, for the lemonade stand, for example, is cash actually coming into the lemonade stand? You could probably make a lemonade stand look pretty good on balance, even if you had stopped selling lemonade for the last month. You might still have cash in the bank and you're still doing all right, but your lemonade's making people sick and no one's buying it anymore. You might see that showing up more on the cash flow document. So cash flow statement gives you a different perspective than balance sheet. And remember, the income statement does as well. That is something that really focuses on profit. Cash flow, you can hide things like maybe a bill is coming due in the next few months, but money's not really going out or in. That's just something you're going to have to pay. The income statement marries that expense with revenue, and it shows you that profit statement. So that's a helpful thing that's a little different than that. So taken all together, you get a really clear picture of the business that you wouldn't get just from one individually. And obviously it's more complicated than this. There are different relationships where net income affects cash flow, and cash flow is calculated using things from over here in the balance sheet. And clearly there are really intricate relationships that you shouldn't be trying to understand. If you're going to actually use those for your profession, you shouldn't be learning it from me. What I can tell you is these three statements exist. They're different. They each give you a unique perspective on the accounting health of a business. That's all I'm trying to say, and that's what the book captures.